Hello and welcome to the Tax Roundup for March. Inside this month, Michael is going to take you through the main residence exemption changes that are currently before Parliament. And these are very much all or nothing changes that impact on foreign residents and also expats as well. He's going to take you through some of the things that you can do about that. But first up, we're going to take a look at the significant changes to the small business CGT concessions that were flagged in the federal budget. We now have exposure draft legislation, and it's quite significant, and it will impact on people that are selling shares in a company or interest in a trust. So across to you, Michael.
Now we've finally got more detail on one of the budget announcements from the 2017-18 budget last year, which relates to the small business CGT concessions. Now this is in some ways quite a significant change and represents quite a departure from what we've been looking at in the past. And last year in the budget, the government did announce that some changes would be made in regards to these concessions to address some integrity concerns about the way the concessions are being utilised. Now the problem was the budget announcement was very vague and very general and really didn't give any indication as to exactly what these changes would look like. Well, until now, and Treasury has released some draft legislation setting out, I guess, its thoughts on how these changes will apply. Really the area that they're targeting is situations where concessions are being accessed or used on the sale of shares in a company or interest units in a trust. Now at this stage, it doesn't look like the changes will impact on other sales, so sales of goodwill or business premises directly. This is very much aimed at sales of interests in a company or a trust. Now what the rules are basically doing is putting in place an additional set of conditions that need to be met before you can access the small business CGT concessions on the sale of shares or trust interests. For example, when someone is selling shares in a company, you look at whether the shareholder who's selling the shares passes the $6 million net asset value test or a $2 million turnover base test. Now, when you're selling shares in a company, it can be pretty hard to pass that $2 million turnover test unless you, as the shareholder, also carry on a business in your own right. Now, under these proposed changes, you would not only be testing the shareholder and whether they can pass certain eligibility tests, you would also have to look at it from the company or the trust's point of view and look at whether the company or the trust would be able to satisfy the $6 million net asset test or a $2 million turnover test. But the way you do that is a bit different to the way you would normally apply those tests. And that's where things get really complex, because the assumptions you make, the entities, the group that you take into account, even the control threshold, all of those things are altered or changed. So you actually need to go through this separate exercise to see whether the entity that is being sold would be able to satisfy those extra tests. Now, in addition to that, there's also some modifications being made to the active asset test. Now, when you're selling shares in a company or interest in a trust, there's a look-through test that normally needs to be applied. You look through to the assets of the company or the trust, and what you need to basically do is check that 80% or more of those, by market value, are active business assets. Now that test is being changed as well. At the moment, you can include cash and financial instruments as active assets if they're inherently connected with the company's business or the trust's business. Now moving forward, the plan is that that will be much more restricted. For example, cash can only be taken into account under the proposed changes as an active or business asset if it's held as trading stock. And that could cause problems for some companies or trusts at the moment where they've got cash balances or balances sitting in the bank account. In the past, they might have been able to argue that those balances were inherently connected with their business. It doesn't look like that will be the case if these proposed changes do proceed. Now, one of the other conditions that needs to be met is that the company or the trust being sold must be carrying on a business in its own right just before the sale. Again, that's not a feature of the current rules. So that could cause problems for some ownership structures, some business structures that some clients have, because they may well be selling shares in a company that holds the business premises, but does that actually constitute a business or not? Well, recent ATO guidance suggests that maybe that'd be okay if it's a company and it's generating rent at commercial rates, but what if it's not charging rent at commercial rates? What if it's a trust? Is that carrying on a business? If it's not, well, it looks like the sale of the interests in the trust could fail under these proposed new changes. Now, the bad news, to make things even worse, I guess, is that the government is planning to proceed with these changes being effective from 1 July last year, 1 July 17. So there will actually be clients who've already sold shares in a company or units in a trust, thinking that they probably meet the conditions, maybe knowing that the government had made some general statement around improving integrity around the rules, but that now has to be completely revisited. Now, the other problem is, of course, these are only draft rules. They're not finalised yet. There's no bill that's been introduced to Parliament. There's a consultation process. It is probably going to take some more time before we even see what the final version of these rules looks like. So I guess the warning is that if you are aware of clients who've sold or transferred or disposed or had some CGT event relating to shares in a company or units or interests in a trust, regardless of whether you thought they were pretty comfortable in terms of passing and accessing the small business CGT concessions, if that event happened on or after 1 July 2017, you're going to have to revisit it. And yes, you might want to have a bit of a look at these draft rules to see how they might apply, but you're also going to have to have a bit of a look to see, well, what happens next? What does the final version of these rules look like? Because it could completely change the outcome. It may mean that client who you thought could qualify for concessions actually might miss out completely, and the tax outcome could be completely different for them. That has flow-on impacts in terms of maybe the plans they were making in terms of putting money into super, etc. as well. So there's a whole lot of things up in the air at the moment. The warning is sale of units in a trust, sale of shares in a company. If you're looking at the small business CGT concessions, this needs to be taken into account because this could have a huge impact on the final outcome.
Now we're going to take a look at those changes to the main residence exemption that are before Parliament.
This month we've seen another development in another budget announcement from last year, which is around the main residence exemption rules. And this is something that a lot of people have been waiting on, just to see whether there were going to be any more changes before the final rules were introduced. Well, now we've got a bill that's gone into Parliament. It's not yet law as of right now, but we expect it probably will be sometime pretty shortly. Now, back in the budget last year, the government said they were going to remove the main residence exemption for non-residents and temporary residents, with the suggestion being that if you were a non-resident or a temporary resident at the time you sold the property, then you'd miss out on the main residence exemption. That was then followed up by some draft legislation towards the end of 2017, which basically fleshed out how that would work. And I guess our worst fears were realised when you look at the draft legislation, and it says that it's all or nothing basically. If you're a non-resident when you sell the property, then you get no main residence exemption at all. You also have limited access to the CGT discount. You don't have the tax-free threshold, so potentially you are up for a lot of tax just because you are a non-resident at the time of sale. Now, I guess the hope was that throughout that consultation process around the draft legislation, that by the time we got some final law, that there'd be a bit of a relaxation of that position. Well, I hate to say it, but the bad news is that that has not been the case. The really strict application of that change looks like it's actually going to become law, which is if you are a non-resident at the time of the CGT event, then the main residence exemption is not available to you at all. Doesn't matter if you've been a resident for most of the ownership period, doesn't matter if you were a resident of Australia 2 days before the sale, if you're a non-resident at the time of the CGT event, no main residence exemption. Now, one area where there has been a little bit of relaxation in the rules is that the restriction on temporary residents accessing the exemption has been removed. Now, that's only relevant really for people who've come from overseas into Australia. They're the sorts of people who would be temporary residents. If they are a resident of Australia at the time of the event, then they can still access the main residence exemption, even though they might be classified as a temporary resident at that time. So it really all comes down to resident versus non-resident. Now, the government has said that this is part of their housing affordability measures. I'm not sure how this ties in with that, to be honest, because I think what it's going to do is a lot of people who are expats, who are living overseas, they're going to start thinking, well, maybe I'm just going to hang on to that property. I'm not going to sell it now. I'll hang on to it because if I become a resident again before I sell the property, then I go back to getting access to the exemption. And for lots of people, it will be a full exemption. So for example, if you've lived in Australia, bought a property here, you've then moved overseas for 3, 4 or 5 years, you've become a non-resident during that period of time, you come back to Australia, become a resident again and sell the property, you could potentially access a full exemption and pay no tax at all on the sale of that property because you can make use of the absence rule, 6-year absence rule. You get 6 years of treating it still as your main residence even while it's being rented out. Even better, if you're not renting it out and it's not being used to produce income, that absence rule can apply indefinitely. So I think what this is going to do is encourage some people actually just to hang on to their properties and dispose of them later after they become residents again. Now, clients will need to be really careful about this. Obviously, it makes a huge difference whether you're a resident or non-resident at the time of the CGT event. For most people, that'll be a contract date, not settlement date. So you can think of lots of scenarios where people are maybe trying to sell their property before they leave the country. If they don't enter into the contract before they leave and become a non-resident, then they're now moving into a position where they're going to lose access to the exemption. Now, there is a transitional provision which basically says that if you held the property at budget night 2017 and you continue to hold it and then you sell up until 30 June 2019, then you can still access the rules as they currently stand. So potentially still a full exemption or maybe a partial exemption depending on the situation. But beyond that, non-residents then lose access to the exemption. Now it gets a little bit more tricky because there's also some special rules dealing with deceased estate scenarios, so inherited property, sales by estate, sales by beneficiaries, special rules for special disability trusts as well. In each of those situations, you're going to have a look at the detail to see how it applies to your client's scenario. But just to give you an example of how that might work, when it comes to inherited property, if the sale happens within 2 years of the date of death, you're typically looking at the residency status of the deceased individual when they died. And that will tend to influence whether the exemption is available on sale by the estate or by the beneficiaries. Where the property is held for a longer period of time, you start to take into account the residency status of, say, the beneficiaries. That becomes more relevant and the exemption might start to become available again. But it will be tricky and there'll be situations where you really need to get stuck into the detail to see how this works. Now, for clients who are already living overseas or where maybe you're aware that there's plans to move overseas over the next year or so, that 30 June 2019 deadline for the transitional rules will potentially become really important to them. Important to start having those conversations in terms of here's what the changes are looking like, here's how the tax rules will apply in this situation versus this situation, and let clients then make a fully informed decision based on this new landscape. That's going to become really important. So, pretty significant change. Unfortunately, it is that harsh change that we were really hoping wasn't going to be the case. Unfortunately, it looks like we're just going to have to live with it and start to have a think about how these new rules will impact on our client scenarios.
And that's the tax roundup for this month. If you're going to the Accounting and Business Expo on the 21st and 22nd of March in Sydney, come and say hi at the Knowledge Shop stand. We'll have our specialists there if you have any questions that are just niggling you might want to ask. But better yet, why don't you see what the membership has to offer and give Julie a call on 1800 800 232. It's the simplest way to stay on top of change. See you soon.